So when we think about the income statement, what should we be focusing on? What are some of the big ticket items? So the income statement deep dive focuses on a couple things. It's the net profit margin, the EBITDA margin, and the gross profit margin. So the first question I get asked is, um, income statements have revenues, expenses, and profitability. Why does this slide only talk about margins? When you're looking at an income statement and you want to assess company performance, I think it's helpful and a better assessment to look at how the business is producing on a month-to-month and year-over-year margin level. And the reason why is because you can tell a lot about how the health of a company is performing based on how the margins move within the months and years of a business. If the business is highly profitable, margins will be higher than industry norms for the business you're looking at. If there's significant fluctuations in the margins on a year-to-year basis, you need to understand, is this due to revenue or is this due to changes in the expenses of the business? If margins went down, say from 20 to 10%, is that due to higher expenses the business is incurring to sustain revenues, or is it another story? So when you're doing this income statement deep dive, I like to start at the margin level because I think it's a better assessment of the health of the business, and you can quickly assess certain things. So what are some common manipulations we see in income statements? And when I say manipulations, you can think of this as errors, manipulations, or findings we come across during financial diligence. So there's a couple things we'll see. For example, revenue acceleration or really revenue recognition. There could be issues of how the company is reporting revenue. So if the company receives prepayments or is trying to take extra credit for revenue, they may be booking revenue that's unearned. So you need to understand when you're looking at the monthly financial statements, is revenue increasing significantly in certain months compared to what their averages are? Um, I'll give you an example we've seen in practice when it comes to revenue. Um, for a construction or project-based business, the company began to receive larger deposits at the start of some of these projects, which typically took anywhere from 3 to 6 months. Um, during the last 12 months of the business, they moved from a 25% deposit to a 50% deposit in order to get started. So when we were looking at the company financial statements, they were reporting the deposits as revenues, which is incorrect from a accounting perspective. But more importantly, they were receiving much more money up front because they changed their deposit terms from 25 to 50%. So it looked like the company was performing significantly better in the last 3 to 6 months of the analysis. When in reality, it was just simply due to the changing of the terms of how they receive deposits. So when you're looking at company financial statements, you want to first analyze, what's going on, what are some of the changes I'm seeing, and then begin to ask questions. When I'm looking at a financial statement, I'm asking myself these questions from a revenue standpoint and an expense standpoint. Other things we'll see are related party transactions. So are there certain things that are owner related? Are there changes in the financial statements related to potential relatives of the business, et cetera? And then how the company records inventory, if it's applicable. So if in manufacturing companies, companies with raw materials, uh, consumer goods, anyone that's carrying a large amount of inventory on the balance sheet, you need to understand how they are recording the inventory at the accounting statement level, and how do they track things like obsolescence? How do they treat inventory when it's sold? These are a lot of things we spend a lot of time in. Revenue recognition, expense recognition, and inventory are some of the areas where the company can manipulate their financial statements to look better than they are. So just be on the lookout for that. So what are some critical considerations when it comes to the income statement? So best practices, when you're looking at an income statement, you want to analyze month-to-month trends and identify some anomalies. So we talked about margins. You want to highlight and discuss when there's significant margin fluctuations. You also want to be looking at changes at the general ledger account level on a month-to-month basis. So I'll give you an example. If a company has a general ledger account called sales revenue or product revenue, if the product revenue is typically $100,000 each year, each $100,000 each month, if in a certain month, let's say in April of 26, they recorded 300,000 of revenue, you want to understand what is the nature of that revenue, where did it come from, who was the customer that delivered it, and why is it significantly different than a typical month for the company? It could be for a variety of reasons. A one-time large project. The company may have completed a large project and they were owed the remainder of funds. Regardless, the approach on the analysis standpoint is the same. You want to analyze on a month-to-month basis and identify and highlight anomalies in the financial statements, and then ask the management team and the seller questions about the nature of the transaction. And this is to identify one-time items in the business to get a better assessment for should you be paying them a multiple of EBITDA for some of these one-time events. I'll give you another example we see in practice. So if a company won a historically large project, if they did not expect this project to occur in the future, there's a question about you as a buyer, should you be paying a multiple of EBITDA for this one-time large project? The sellers will say, we're going to win more of these projects going forward. Yes, you should pay us, 3 or 5 times the net income of this large project. On the buy side, on the buyer standpoint, it's challenging to guarantee you'll receive or win a project this large going forward. So there is a push-pull when it comes to, why are we analyzing the income statement? And then how does that apply to your deal? Typically in practice, once some of these one-time events are identified, working with a QOV provider such as O'Connell Advisory Group, we take those QOV findings and we apply them to your deal. So if it does warrant a purchase price reduction, explaining that to the seller and the representatives in a clear and concise manner is really how you can maintain your deal and show them a logical paper trail of why you think something should be one way or another. A couple other things to think about, which we see in practice, are ignoring timing differences between how revenue and costs are recognized. For example, at year end, so in December of 25, the company may have incorrectly recorded certain revenues and expenses, or failed or forgot to record certain revenue or expenses in the correct period. This is called cutoff testing. So what we'll do when we're doing a quality of earnings is we will look at the cutoff periods. So for example, the last month of our historical period, if we were doing a deal today, typically that is February 2026 is the last month of our historical period. That would be our cutoff date. So we would look at how things are recorded in the last month of the transaction. We would also pay close attention to January of 26 and December of 25. We would do the same exercise for the year before. And the reason we're doing that is we're looking to ensure that revenue and expenses were recorded in line with generally accepted accounting principles or GAAP to make sure there's not any timing challenges with the accounting records of the company. As we kind of get through this, I'd love to hear, so where are you in your search process? If you want to fill out the polling question that's going to come up, are you under LOI, actively searching, or just starting out with your search? If you'd let me know, it helps me better tailor the presentation and the webinar to those who have joined us. If you have any questions about your deal specifically, or a deal you're looking at, I would be happy to answer some of them a little bit later in the presentation. I appreciate the under LOI comment. I'd love to hear more about what type of business it's for. Maybe I can share some dialogue a little bit later. So if you are under LOI or you're actively searching, which it looks like it's about a mixed bag, what is a typical timeline? This is a question I get answered a lot. So a typical timeline, if we think about an LOI period, is anywhere from 30, 60, or 90 days. So when I speak with self-funded searchers or sponsors, it's once you are under LOI, what are the work streams you need to do to get to closing? So the reason why it's important is if you think about how you arrived at a contract under LOI, you probably spent several months, if not years, searching for your perfect business or the business that was your ideal buy box. Once you secure an LOI, it's very important you quickly and methodically conduct due diligence the right way. So what do I mean by that specifically? This is a typical due diligence timeline. So if you want to bookmark this and save it on your desktop, I use this for all of our deals because it shows the work streams of what you should do. So typically on day one of your LOI, you should kick off confirmatory financial due diligence conducted by a third-party CPA firm like O'Connell Advisory Group. The reason why you do this is you need third-party verification in order to make it easier during the SBA underwriting process. If you're looking to raise outside capital, they're going to want to see a third-party CPA report about the investment they're looking to make. It gives you more credibility if you're looking to raise. If you're looking for conventional debt, so if you're not doing the SBA route, they typically will also need a third-party verification from a CPA firm. Some banks conduct this internally, but that is for the SBA side of things in order to issue SBA loans. It is not to represent you as a buyer. From there, you would kick off things like tax due diligence, legal due diligence, and the final closing period is typically in the last 30 days. The legal side of things is going to do background checks, drafting up the purchase agreement, and then fine-tuning some of the reps and warranties in the purchase price agreement. The reason why you kick off financial due diligence and the underwriting process typically in the first 30 to 60 days is because you want to ensure There's not material discrepancies in the financial data which you submitted the LOI on. When you submitted the LOI, you likely were leveraging marketing materials and a SIM prepared by the seller representatives, but you need to confirm that the information in the SIM and marketing materials matches the accounting records of the company. So if the company uses QuickBooks or another accounting software, you need a M&A CPA accountant to rerun the financial statements and confirm at the accounting basis level, the revenue, income, and expenses of the company match what was your perception at the time of LOI. If there are challenges and discrepancies in that data, it could lead to the deal falling apart, not being able to get bank underwriting. So it's best practice to not pay for attorneys, tax experts, etc., until confirmatory due diligence is done by a financial due diligence provider. If you want a copy of the tools, templates, and everything we use, feel free to scan this QR code. This is a financial due diligence data checklist. So this includes all of the items we use at the start of each of our deals. It's a quick template you can find and use for your next deal if you're under LOI. Feel free to scan the QR code and we can get that over to you sometime today. So comparable private company data is challenging, but I do appreciate the question. You can leverage independent research. There are paid sites such as DealStats who have verified private data. At least that's what they've told to me. I've used DealStats in the past. So I would leverage that. If you head over to Search Funder or speak with people in network, I'm sure they maybe have a few other providers they will use, but I'd probably start with DealStats. So there's a lot of discussion around EBITDA and SDE. For purposes of the income statement analysis, SDE you will hear a lot for smaller self-funded search deals. EBITDA is effectively, the earnings before interest, taxes, and depreciation. That is a clear middle market definitional calculation. The calculation of SDE, in my opinion, can be vague for a variety of reasons. The SDE is the seller's discretionary earnings. So it's effectively what are the earnings of the business, after you calculate EBITDA and you take into account the owner's compensation. Two things I always like to say when people ask me about SDE and to be careful of. SDE takes into account what is called the owner's benefits. Owner's benefits is a very broad term, and there's different owners who have different definitions. Regardless, the things you should be adding back to EBITDA, which is included in owner's benefits, you need to ensure it's recorded on the income statement as an expense. So I'll give you an example. If the owner takes a $100,000 salary as the owner's salary each year, it would be appropriate to add this back if he is expensing this on the income statement. So, why is that? The reason is because if the owner is expensing his salary on the income statement as an expense, his net profit, is lowered by that amount. Makes sense, right? If he has revenues of 200,000, he pays himself $100,000 and records that as an expense, his profit should be $100,000. Disregard any other expenses of the business, but it's a simple math formula. What I see in practice often is that owners will not expense their salary on the income statement. Regardless of whether that's right or wrong, the more important thing is they will try to give themselves extra credit for this salary in the SDE calculation. And the reason why that's not allowed, in my opinion, is it overinflates the perceived earnings of the company. The EBITDA is effectively higher because that expense is not hitting the accounting records. And then you're looking to add back a salary. So it effectively makes a business look good, make it look exceptional. As I think about my own business, my own salary is expensed on the income statement. So if I were to effectively show it a seller discretionary earnings calculation, it would be fine and reasonable to include that salary in the calculation. So just keep that in mind when you're looking at SDE. I have no problem using it as long as those items the owner's looking to get credit for are being expensed on the income statement. So let's jump into a case study about the income statement and walk through some trends. So let's put some context. So we were evaluating a target company, and the buyer was focusing on validating sustainable earnings and consistency for a business specialized in manufacturing and infrastructure. The buyer wanted to confirm that the reported revenues of approximately 7 million and they had EBITDAs of approximately 2 million. This sounds like an upper end for a self-funded search deal, given that it had EBITDA of about $2 million. So what do we do to verify this? So you started with the historical period. The historical period, in my opinion, we often will do 3 years. We then moved into performing this vertical and horizontal analysis at the income statement line item. If we flip over to the flash of the income statement, it'll look a little bit better of some of the findings. So when we show the financial statements on a line-by-line basis, a couple things jumped off the page. If you head over to the next slide, we can show the vertical and horizontal. So if we look at a snapshot of the business, this is the truncated annualized income statements of the business we were speaking on. So you'll see that margins were very strong, 69% gross margins. This is a very good looking business. The cause for concern, if we look at the horizontal, the historical analysis, is if we go to the last column, the incomes declined 10% year over year. So it went from 7.8 to 7 million from 24 to 25. But margins improved. And so if we look at the cost of goods sold actually declined at a greater rate than the decline of revenue. So some people, will look at this and say the business is in decline. I'm not sure if I'm interested in it. They want to see businesses continuing to go up. When I look at this, I actually like the trajectory of this, and I'd want to learn more. Given this business may have had certain customers that weren't as profitable, or that were costing the company too much money, they decided to end the relationship with, because they're actually making, if we head down to the net incomes, roughly 27% at a net margin level of about $2 million on only 7 million of top line revenue. Compared to in 24, they were doing close to 8 million with very similar net income levels. So I'd want to dissect, what is the composition of his income? More importantly, what is the composition of the cost of goods sold? This total COGS number, this 2.8, is that materials cost? Is that labor costs? What's the composition? I would want to do a deep dive into the line item called total expense, understand the composition of that. If you look at that on a line by line basis, it's relatively flat. It's 2.9 million. There could be several fixed costs baked into this number. So, assessing the composition of this total expense line item would be something I'd want to do. And then if we head on down to the EBITDA margins can be found in this vertical analysis, 27, 29%. So these are quite strong. Depending on the industry it's sitting in, I'd want to learn more. Some of the other findings we focused on when we were doing this deal was we noted that there was significant improvement in gross margin, and it was driven by things like sustainable pricing power. They changed some vendor costs. So they cut some vendor costs or they renegotiated them to lower some of their expenses. And they had shifts in the product mix. So the product mix changed slightly, and they began to sell less of the products with lower margins, and they moved to some of the higher margin items. When we're doing this analysis at the financial statement level, we typically will go line by line to do a deep dive and assessment of each of these certain items. So within line, the total income, there may be 4 to 6 general ledger accounts that comprise the sales and income of this business. So going on a line by line basis is best practice. So what did the vertical analysis reveal? We kind of touched upon this, but it said, the gross margin expanded from 60 to 69%. Revenue dropped 10% in 25. But I like how the business margins continue to improve, even though the incomes declined slightly. So if you have any questions about this particular, I'd love to hear more from you all. If we want to keep it moving to the next few slides. So we kind of touched upon this, the vertical analysis, which that was those 3 columns alongside the income statement, shows a lot about where to double click. And really, you could think of the vertical analysis as really that margin analysis. So we touched upon a lot of these things, but when you're doing this income statement analysis, it's important to include those columns and conduct a proper vertical and horizontal analysis for the income statement. It will tell you and answer questions about margins, what changed with the business, and it sets the stage for a dialogue with the management and sellers of the company. So the historical analysis, this year-over-year analysis, shows a few things when we think about the snapshot of the P&L. As kind of mentioned, if we zoom in a little bit on the key year-over-year movements, revenue declined from 24 to 25. It went down about 10%. Um, but the continued margin improvements looks to me that the health of this business may be improving. So, I'd probably ask, a few more questions about it and, try to get a better assessment. Um, I created the Business Buyers Toolkit really for an internal guide, as the folks at OAG can do better deals, but I love sharing it with the folks who join this webinar. This has, I think, 92 or 107 pages of the 2026 edition. It includes things like the timeline, due diligence process, a management questionnaire. So if you want to scan the QR code and receive the 2026 version, um, feel free to. You should get a copy today. So, when we think about the red flags in this income statement and really the key takeaways, we touched upon a lot of these, so I'm not going to go overkill on it. You want to conduct the income statement analysis by first compiling it in Excel and doing the horizontal and vertical analysis. Um, this sets the stage for your due diligence. So if you're hiring a third-party provider, they should be doing this on a management meeting. A management meeting is when the CPA firm and you as the buyer will meet with the seller and you'll conduct this income statement analysis live. So they're going to go line by line and ask, tell me the nature of why revenues declined year over year. Talk me through total expenses. If you think back to the example, revenue declined. I'd probably ask questions of, were there certain reasons, and see what they say, get them talking. I would then ask them questions about, the cost of goods sold. Why did it drop faster than the decline in revenue? Did they make some cost changes? Were there changes in vendor relationships? You may know a lot about the company if you are under LOI, but you don't know as much as some of these legacy owners. So it's best practice to ask open-ended questions and let the data drive the narrative. I find that's best practice. So some of the key takeaways, I always say, you know, the the truth of the business lies in the financial data. Uh, you may get excited about the opportunity of owning this asset, but the numbers should dictate whether or not this makes a smart investment at the price you're paying for. Um, when you're thinking about making a smart investment, leveraging a proper deal team will help you free up your time to spend in the areas that you excel at. Um, Digging through income statements and general ledgers can be significantly time consuming. And a lot of self-funded searchers and even small sponsors will use a lot of their exclusivity timeline doing more digging of the data than they probably should be. So by arming yourself with a deal team, you can supercharge this process and make sure there's not a material red flag in the business before you take on an SBA loan or significant conventional debt for this business. Really, the point of doing income statement, a quality of earnings review, etc., is to make sure that this business has sustainable earnings and can support this debt that you're likely going to take on in order to buy the business. An over-levered business has a risk of bankruptcy. An over-levered business causes stress and a cash crunch for new owners. And the risk for a default significantly increases if you overpay for an asset. So when you're thinking about your timeline, where you are in the process, keep this in mind. you know, as you start this journey. Uh, the income statement is just one piece of the puzzle. This same vertical and horizontal analysis should be conducted at the balance sheet level. We have, as part of this webinar series, I'm going to talk about that on another webinar. You should automatically be signed up, but if you're not, keep an eye on that one. It's going to talk about things like when you are given a balance sheet, where do you begin? What are some of the risk areas of the balance sheet you as a buyer should look into? And how does that impact your deal? I'll give you a little snapshot because we talk about this a lot on some of our deals currently. There's a discussion around working capital and whether working capital will be delivered at close and how will it be delivered. This is a key component of working capital analysis and balance sheet analysis in deals. The reason why you conduct a balance sheet analysis is because your accounts receivable is likely a material component of your balance sheet. So how you are delivered working capital really is predicated on how accounts receivable is transferred at the time of closing. So you need to understand the composition of AR. Is it collectible, and how is it going to be transferred at the time of closing? Do you have a right for AR? Like, are you going to be granted the benefit of those accounts receivables at the time of closing? Or does the old owner want to receive those monies, either before closing or after closing? That's a sticking point we see a lot in these deals. So we're going to dig further into that, a little bit later in the next webinar. We kind of touched on this, but if you want to scan this QR code just to double check you are registered, this is going to sign you up for the entire webinar series. So next session is going to be working capital, setting the stage of why you should do it. Then we're going to talk about balance sheets. And then we're going to talk about the phased financial due diligence. So this is one that I will speak with a lot of folks who are under LOI, and they ask me, how is due diligence conducted? We conduct it a little bit differently at OAG. We phase it in order to mitigate risk, focus on the key areas of emphasis earlier in the process rather than later. And it protects the buyer, mitigates the risk of broken deals, and sets the stage for just a more thoughtful financial due diligence. So I'm excited about that one. It'll give you more of an insight into how we work together if you think we're a good fit for your deal, and how you should be thinking about staging due diligence. Because, the sponsor is the quarterback of this deal, and your deal team are really just the players. With that, I'll go ahead and pause for a couple questions. All of this content and more can be found on my YouTube channel. If there are topics you think we haven't covered, I would love to hear from you. I started this channel at the beginning of 2025, and it was really for educational purposes only. I've received a lot of great feedback, but I always want to tailor this to be the most valuable for sponsors and this lower middle market deal community. So if you have feedback of what I could do better, topics you'd like covered, feel free to reach out to me, and we'll see if we can add it in the coming months. With that, I'll go ahead and pause if there's some last minute questions. Anything, I'm kind of an open book. So we'll go ahead and pause. Yeah, so one question that came in was, what is, I guess it's a twofold. The individual asked about the concern that a company might be overwhelmed by a management meeting. which is totally fair. Management meetings, especially for first-time sellers, can be overwhelming. I would say uh, you want to conduct a management meeting for a few reasons. One, it is a significant red flag if the owner is unwilling to speak about the company's financials during due diligence. The second is you, as a self-funded searcher, do not want to be conducting this management meeting or interrogation. You really want to leverage a third party to act on your behalf. Um, Sellers can be very defensive, so it's important to separate yourself and remain, retain that goodwill with the owner. So that's really where hiring a deal team to ask those tough questions pays for itself. Um, I'll give you a few examples about why I always recommend you don't sign and close on a business until you have a management meeting. And the reasons is I've uncovered uh, several instances of fraud or material misstatements in the financials that I would not have known about if we did not conduct a management meeting. So the follow-up question I get to that is why, or how is that possible? Um, Even with a trained eye, and I've been doing this for over 15 years, at some point in your analysis, the numbers, um, you know, can only give you so much insight. You need to corroborate the financial data with the seller's dialogue. So when the seller starts to discuss the operations of the company, you're going to learn a lot more than just by looking at the income statement. It's a superpower if you pair good income statement analysis with proper management questions, because this is how you reduce the risk of fraud and material misstatements at the accounting statement level. Typically, whether or not you engage us or a other CPA firm is really preference on your risk tolerance. We do deals as small as $1 million all the way up to 30 or 40 million. It depends on your perceived risk and whether or not you're comfortable hiring proper representation.